Welcome to the weekly video update, where I'll go over the action in the market for the week of May 13th through the 17th, and then we'll see how things look for the week of May 20th through the 24th. Had another up week. We're looking pretty positive right now on the daily charts on all the different time frames. We're looking better here on the weekly charts. Now, at some point, the market's going to want to come in and take some profits. If that happens, we'll be evaluating things every day to see what's the intensity of any kind of a decline, whether it looks like just a pullback and we're still maintaining a positive stance, or if we're starting to turn a little bit more negative. Before I get started, please know that I do post videos every day, and I have an announcement to make right after this slide about the daily videos. But I go through all of the charts every day, and I post commentary and analysis on the daily charts and just evaluate things from a day-to-day basis. Over the years, I found that this is the best way to look at things. I do have some launch videos about the program that I'm going to be starting in June. Those are available as a playlist on YouTube. They're also available on Rumble, but I can't make playlists on Rumble, so you just kind of have to search through to find the different program launch videos there. Also, there's a PDF that's available with every video that I post. Doesn't matter what video it is, I always turn these slides that you see right now into a PDF and then upload that, and it's in the description. There's a link so that you can download that. There's also a new weekly video that I've been doing called the What to Watch video. That's the last video that I do each weekend, and that's what I'm really honing in on. Then every day I post what are called pivot points on the YouTube community tab. I can't do this on Rumble. There's a daily chart that the pivot points last for the whole month, but I update that chart with the previous day's candle because they're candlestick charts. And then there are intraday pivot points, and those can be quite useful. Also, I do have a private Facebook group that you're welcome to join. Now, I am going to be starting the program, but there'll be an area in the program where folks can talk to each other and there can be some back and forth. However, if you don't want to join the program, this private Facebook group will still be there if you want to have questions and you don't really want to become a member. There is a poll that I'll go through the results here in just a moment, and then I'll be posting some questions for the upcoming week. Also, with YouTube and Rumble comments, I'm still having to go through and delete a lot of the comments on Rumble. They're still running these webinars or whatever and teaching people that they're automatically YouTube experts and Rumble experts, and they can help you increase the traffic to your channel and make it look better. I'm just fine with the way things are growing right now. So I just go through and delete those comments. Now, if you have a legitimate comment, well, even if you disagree with something that I say, please feel free to post that comment. I have no problem with that. Now, if you want to make it a little more private, at the end of this video and coming up on the next slide, there is an email address where you can send me a message, and it just stays more private, so not everybody can read that. And I also post on Rumble as well as YouTube. Here is the link. If you can't find me on one platform, feel free to jump over and look for me on the other platform. Okay, here's an announcement about the program that's going to be launching. The daily videos, if you watch those are going to be locked down starting Monday, June 3rd. Now, what that means is instead of making them available right after I create them and upload them, they're going to be available just to members until the market closes for that day. So if it's a daily video for Monday, it would not be available publicly until the close for Monday's session. Then I set a timer on the video, it automatically clicks over and becomes public. But half the people that watch these videos do it after the market has already closed. So this is not going to impact you. It's still free if you watch it after the close. If you want to have early access to those videos, it is $19 per month. Now, there is a membership program that I have, and that's $97 a month, and there's a lot more involved in that program. But let's say you don't want to become involved in the membership program. You just want to have early access to the daily videos. It is $19 per month. The membership program will be $97 a month, but it's quite a bit more involved than what I go through now. The other videos that I post, like this video, the weekly video, the intermarket analysis video, the deep dive video, and the what to watch videos, those are still available right after I finish recording them and upload them to YouTube and Rumble. To me, the daily videos are most important, and that's the real benchmark of the analysis that I do, and that's where I make my decisions. I use the other videos just as kind of supplemental videos to give us an idea what's happening on a bigger scale and across different markets. And so I'm still going to keep those available as they are posted. If you want to talk to me about this, here is an email address, and it's the same email address that I provide at the end of the video. Okay, so let's go back and talk about what happened. For the week, we were up 1.54%, another up week. We were still below average with volume. We saw that last week. We saw this week, and that's a classic technical analysis warning sign 101 when we're going up on below average volume. And so that is a bit of a concern. But at the same time, price is the ultimate indicator. And as long as we keep going up, we'll still deal with below average volume. But at some point, we want to see volume come back in and really show that there's conviction behind the move. We are still positive with our technicals for right now. We're looking more positive on the weekly charts. We're positive in the short, intermediate, and long term on the daily charts. In some places, we're actually starting to look a little too positive. You can take that as we're overextended and due for a pullback. You can also have that determine that maybe we're showing good momentum, because we can stay at these levels for extended periods of time when the market is really going up. It's about inflation and interest rates. We had the PPI and CPI come out this past week. The PPI was a lot stronger than expected, but the market really rationalized this away by looking at the revised numbers from previous months, and they revised those numbers down, and the market ended up going higher. Then we had CPI come out on Wednesday. That came in friendly with the current numbers, and the market shot up after that. And so the market's liking where things are at for the time being. But we just want to be aware of this. We don't know if this is going to gradually move over into where inflation is continuing to go back up, or if it's going to start to come back down. Now, one thing that you're probably seeing lots of different videos and posts and things like that, thinking that we're going to really decline, that there's going to be stagflation, that the market's going to crash. Well, that may end up happening at some point. We can just follow this day by day. That's why the daily videos are most important to me. And we can generally see these things coming. They don't just come out of the blue unless there's some kind of a black swan event that completely catches the market off guard, like the COVID lockdown that we saw. That hit the market off guard and we really went down, but then we V'd right back up out of that. And usually after some of these black swan events end up happening, we tend to resume the trend that was happening before that event ended up happening. 9/11 was a good example. We were already going down, and then the terrorist attacks hit, and that just made us go down even more. Well, the COVID lockdowns, we were already in a solid uptrend. We fell, we came back, we reestablished the trend. It was a scary period of time there, and the perma bears were all happy about that, but it didn't end up lasting all that long. And then for 2021, we just kept going up. So we just want to be aware of these things at the same time. We want to keep an eye on the different geopolitical concerns that are out there. Usually these don't have a real impact on the market, but sometimes they can bleed through. They can affect oil, the dollar, gold, and that can sometimes come through and actually have an impact on stocks. And then earnings are starting to slow down a little bit now. We're kind of beyond the real busy time as far as earnings season is concerned. And then in the upcoming week, we're going to have the FOMC meeting minutes that will be released. That'll be Wednesday at 2 p.m. Eastern time. As far as our trend, it's still a weakening trend for right now, but it's trying to get stronger again. It's positive with the green line on top. The green line is above the red line, and it's still trying to get a little bit stronger now, and I'll show you that chart. So for the week, just some bullet points. Stocks had another up week. The Dow ended up closing at 40,000 for the first time. When I first started this in the early to mid 90s, they were wondering if the Dow was ever going to get over 4,000. Now we're at 40,000. So those of you that think you're kind of being left behind, that maybe the opportunities are over for now, well, look at where we've come just in the last 30, 35 years. Are we going to get to Dow 100,000 at some point? Well, we'll just have to see as that happens, but it's not going to go straight there. There's going to be bumps along the way for sure. Interest rates in the US dollar for the week, they ended up being down, and that gave support to stocks. The economic reports that came out, as I mentioned, they were taken as friendly, and they even twisted it around because the market could have just tanked on Tuesday when PPI came in because it was a lot stronger than expected with the headline numbers. And the market really had to dig deep to find a reason to twist that around and make it positive. And that's what I'm talking about, where the market is always right. We have to go with price. That's the ultimate indicator. No matter what our charts are saying, no matter what people are saying, no matter what logic you may apply to the market, the market is always right. Now, at the same time, it may not always be correct. There's people that I listen to, there's some podcasts, they talk about how stupid bond market, stupid stock market, stupid hedge funds, stupid Fed. Fine, they may be stupid, but it's what the market does that we ultimately have to follow, not what somebody says they think it's going to do. And that's why I look at all these different charts to reach a consensus of what is really being told to us right now as far as the story, because that's what's really happening is what we see in the charts. That's all the known information at this time. And that's why I really rely heavily on technical analysis, because there's sometimes a real disconnect between human logic and stock market logic. And there may be times when it keeps going up and up and up, and it defies human logic, but yet the market's still going up anyway. All right. Earlier in the week, Fed Chair Powell came out in a moderated discussion, and this doesn't give you an awful lot of confidence, when he said the data at that time was quite mixed. Now, this is the person who's supposed to really know what's going on. And to come out and say, some of it's strong, some of it's weak, doesn't really show an awful lot of confidence for right now. Meme stocks, if you know what they are, those are, it's like GameStop and AMC and I think Bed Bath and Beyond and some other ones. I never got into that. I did post a video a couple years ago when this was all the rage, and I talked about what was happening, and I used that as a teaching opportunity to explain about the bid and ask price, to talk about going long, going short. So it's way back in 2021. You may want to go find that. It's on the YouTube and Rumble channel. But there's this person on Twitter, also known as X, called Roaring Kitty. They posted something, and this got all the meme stock people all active again, and it's all over the place. Now, none of these stocks are in the S&P 500, so it really doesn't concern us. It's just part of the craze that seems to hit every once in a while. Earnings reports are starting to slow down. Earnings season never really ends, and it never really starts. It kind of starts, I think, with Alcoa and then ends right around when Nike reports, I believe. But it kind of just slows down and picks up, slows down and picks up. Then looking at the week here, the Dow was up 1.2%. The NASDAQ was up 2.1%. We had the S&P up 1.5%, and the small caps had a pretty good week, but they're just coming into the high end of their range that we were at before. But they were still up 1.7%. This is a chart that I've been showing for about a year now. I haven't worried about updating this because this is a very long-term chart going from 1966 to 1982. And we're still in this downward move. If you look at the blue line, where we did tick back up even in 1976, and then we started to come back down. The reason why I'm showing this chart is not because of what's happening necessarily right now. It's what might happen after we get done with this downward move in inflation. And a lot of people are predicting this, and it may end up happening. It may end up not happening, and it may end up happening not as strong as what we saw back in the mid to late 70s. That's why we keep an eye on things. That's why we evaluate things every day. Where we saw this really going up, super high inflation. It was actually coined a new term called stagflation, where we saw very, very high inflation, but yet people weren't getting paid more at their jobs. We weren't really seeing much, if any, economic growth during that time. And it really didn't get under control until the early 1980s. We don't know if something like that's going to happen. There's certainly a lot of people out there that think it's going to, and it might. But to say this with any dogmatic conviction is just, it's out of place right now. We have enough information here. This doesn't happen overnight, and we'll just keep an eye on these things and then reevaluate things as they develop. Also, looking at the RenMac research, whenever we get above 4.02% with the 10-year yield, that's when it starts biting into corporate profits. Even though the 10-year yield was down this week, we still are at 4.42% for the 10-year yield. Then looking at the poll results, the first question, the parabolic SAR. A week ago, that switched to positive, and it's positive again this week as well. We saw that confirmed with the daily chart. And I said, this provides confirmation. Do you feel that this will help lead to a continuation of an advancement of the S&P, or is this a false signal? Okay. 33% thought that it was going to lead to more advances, and that ended up being what actually happened. A decline, 17%, and that we would chop sideways. That was half the people thought that would be what would happen. Then the mass index, and I'm still not quite sure. We're still working off of this signal. When it was initially triggered, it's because we were going up, and that's when the signal was triggered itself. It usually tries to identify a reversal, but to this point, it doesn't seem to be legitimate. So the right answer for right now is that this was a false signal. Well, a week ago, 57% thought that there will be a decline, and 43% said, I don't really know. I need to look at some other charts in order to confirm this. And that was probably a pretty wise thing to do as well, because it does look like it might be a false signal. Utilities and staples, they've been strong, and this has been a concern, and it's still a warning to us. But a gentleman by the name of Jason Gepfert, who created a site called sentimenttrader.com, and I can't show you charts from his site because of copyright laws, but he's got some really unique studies. He posted something on Twitter, so if it's posted there, I feel like I can show it to you, that says, okay, utilities and staples, they're usually more defensive, and these are what folks get into when the market starts to getting ready to go down. This is what we saw at the end of 2021, right before 2022 happened. And so a lot of people are a little, including me, are just a little bit nerved by this. But does this concern you? 25% thought, no, this time is different. 50% thought, yes, this does concern me. And it kind of concerns me now. 25% said, I don't care what happens with that. And then as of Friday, May 10th, a week ago, the S&P and NASDAQ were within 1% of hitting a new all-time high. We set new all-time highs this past week as well. However, volume has been decreasing. Does this concern you? 60% said yes, 20% said no, and the other 20% said, I don't really care. Okay, for right now, it doesn't seem to really matter. But at some point, the market may reckon with that. Looking at some Isabel Net blog charts, these are the earnings forecasts going forward. And as long as we're going up across the board here, that is more positive for the market. Earnings are what ultimately drives stock prices. And then this is a chart, and I kind of tried to blow up this box here down below. This is don't fear new all-time highs. These are the returns after the Dow hits an all-time high. Not only did it hit an all-time high, as I said earlier, it also closed above 40,000. And just to show you, 1 month, 3 months, 6 months, 12 months out, we see pretty good, a positive percentage and pretty good returns going forward. And it gets even better the longer out that you look. There's a little difference between the 6-month and 12-month returns, but new highs doesn't necessarily mean we have to stop. There can be more new highs generated after this or in a positive environment. This is showing how a lot of money is really going into utilities. People are seeing this. Now, are they late to the party or not? We don't really know. The light blue line, that's the flows that we've seen over the last week. The dark blue line, that's the 4-week moving average, and that's starting to come up as well. And a lot of times what people do is they see something, oh, utilities are hot, they get into it, and then that's when it tops out at that point. That's why we look at all these charts. We try to see things developing before they get to the point of exhaustion. But there's just an awful lot of money going into utilities right now. Sentiment, this is getting to a pretty high reading, but it could still go higher. We look at a lot of different sentiment indicators. This one is a little bit extreme. The other indicators that we look at, some are extreme, some are not really showing that we're extreme, at least yet. Then looking at the revisions to the Magnificent Seven compared to the rest of the S&P 500, they're revising them up 8% with the earnings per share, where the S&P pretty much flat, and then the rest of the stocks, there's really 505 stocks in here, but they're actually looking at a minus 2% when they're revising earnings going forward. Then looking at what is inflation going to be, see, we get a month over month reading, and then you have to annualize that. And what does that mean? Whatever we come in with, that's what it translates to on an annual basis. Now, we're not going to get this report for another 3.5 weeks, so this chart is going to be quite out of date by then. And then the proportion of S&P 500 companies that are mentioning AI during their quarterly earnings calls, they're just going through the roof. We've got a new version of ChatGPT that's coming out. Google made an announcement with, what's it called? Gemini is their AI program, and that's really pushing a lot of buzz into the market right now. Plus, we potentially have some positive seasonality in June, July, and August. That can be good for tech stocks. At least seasonally, it has been. Looking at FactSet, just these two charts to show you here, these are just talking about inflation, and a lot fewer companies are talking about inflation in their calls. So they're talking more about AI, but less about inflation, where the raw number is coming down, and we're seeing this also start to trend down as well. Looking at the intraday chart going back to Monday, where we were kind of flat. This was a pretty slow day. Tuesday ended up being kind of slow. This is when PPI came out, but we saw some strength later in the day. Then on Wednesday, this is when CPI came out. We gapped up and then just shot up from there. We actually went up to R3, which I have to calculate myself. My software doesn't automatically put that on the chart. Then on Thursday, we went up, we hit a pivot point, and then showed a little bit of profit taking, and we were pretty much flat. This was a real yawner of a session on Friday. We ended up closing just slightly higher. So for the week, and this is just the 5 trading days for the week, we had the NASDAQ 100 and the NASDAQ back in the lead, followed by the S&P. All of the indexes ended up being up. Even small caps were up just for the 5 trading days. Going back to the beginning of the year, all of the indexes are now positive, including the small caps. They're now positive as well year to date. Looking at our different sectors, and they added some information here. It actually shows you volume and market cap. Those are additional columns that used to not be here. When we have an up week, this is how I sort it, with technology doing the best, followed by real estate. Yeah, it's seeing a little bit of love these days. And then healthcare, which is more of a defensive play. The financial sector, which that's good for the market, and utilities are still quite strong. They ended up being positive on the week. We only had one sector, the industrial sector, ended up being down. Then the next chart, I sorted according to this scooter score, and this ranks how's that sector on a score of 100, 0 to 100, and we're up into the 90 range when we look at utilities. So it's still a strong sector, followed by the financial sector in the 80s. And we still have discretionary way down at the bottom. It's not totally negative, but it is the worst performing sector currently. And this is part of the discretionary versus staples that we've been keeping an eye on. And you can see up here more in the middle, staples are actually doing better. We look at our relative rotation graph. The upper right, that's a plus plus. These are the strongest areas. We still have energy over the last year, which is showing a lot of improvement. Then we have materials. Industrials, which are on a short-term basis looking a little bit weaker, but they're still strong overall, including the financials and the communications sector, where even though real estate saw a good week, it's one of the weakest sectors going back over the last year. We also have discretionary, which is weak, healthcare, which is weak, and we also have tech, which has been showing some weakness compared to the strength that we've seen in the past. Then we look at the major market indexes, and where are they? We still have the mid caps looking strongest over the last year. The SPX, that's the S&P 500, and the OEX, that's the S&P 100. Small caps are still kind of doing about the weakest. Even the NASDAQ 100 has been under some pressure lately. Where the transports, yeah, they're doing better, but they're not really breaking out. And this is the Dow Jones Composite Average, which takes the Dow, the transports, and the utilities and puts them together. They're showing a bit of an improvement, but a lot of the strength had been coming from the Dow. Now it's coming from the Dow and the utilities. The transports aren't really contributing anything. And then we see the real move up in utilities as well. So just looking for the 5 trading days over the last week, we had tech, real estate, healthcare, and financials were positive. The rest of the sectors ended up being negative for the week. That's not a week over week. It's just the 5 trading days for the week. Going back to the beginning of the year, we have communication, utilities, and tech are positive. Energy and financials are positive. The other sectors are now negative. Sentiment, not really seeing anything extreme. We're looking extreme with that sentiment indicator that I showed a few minutes ago, but this one still has a ways to go. When we get up to 75, that's when we're starting to get extreme positive. And here's a historical chart. And we tend to go with this until we get up into the 75 area. Usually we drop down to 25. We didn't get down that low. This is when we start to look at using this as a contrarian indicator. Well, if we get up to 75, we look at using it as a contrarian indicator to go down. But you can see earlier in the year, we stayed up around the 75 level for quite a while. So in a good, solid market environment, this can stay extended. Here's the active asset managers. It did tick down a little bit. They had been just barely extreme positive. They ticked down in the latest reading. So this reading is at 89.25, just a little bit of a tick under extreme positive. The VIX really came down. We've been dropping with the line chart and the bar chart, and I've been really watching the VIX lately. We actually closed under 13, or was it under 12? We're getting a very low reading, and I can't really see that. Yeah, we closed under 12. It closed at 11.99. That's a very low reading for the VIX. Now, according to Tom Bowley's research, this is when the S&P really has some good annualized returns. It's until the VIX goes back up to 20, that's when we tend to see negative annualized returns. Here's the Ulcer Index, which has been flattening out recently, and it's really been dropping on the daily chart. And we're still looking okay here between the spread between risky options for bonds and not as risky options for bonds. When this is going down, that means they're not seeing an awful lot of fear. We're getting very low readings with this. And it's when it spikes up, that's when we get really concerned about things. The latest rating from the Investors Intelligence Survey, we're ticking up just a little bit above 3. Now, this is generally considered extreme positive, but we could still go higher than where we're at right now. The latest rating from the American Association of Individual Investors, we are showing some improvement here, but we're not seeing an extreme positive reading. A lot of people missed that move because we were going down in April, and all of a sudden things started to shift over and look more positive, but a lot of folks didn't really trust it, so they didn't take advantage of it, so they missed some of that move. This is also still looking positive. When this black line is going down, that means the tech sector is outperforming cash. And so this is still looking positive. Some readings on GDP, where the GDP now is coming in at about 3.5%, according to the Atlanta Fed. Looking at the range of the top to bottom, we're just under 3% to the upside and about 1.25% to the downside for GDP. Also, this shows what we're looking at. The takeaway from this is we're not seeing any negative projections for right now. When GDP turns negative, that means we're going into a recession. And if we stay there for 2 quarters back to back, that is one of the definitions of a recession. Also looking at GDP here, going forward, where the diamonds are the consensus, and this is what Goldman Sachs thinks is going to happen. The real takeaway from this is all of the numbers are positive at the present time. The Ridex Bear Bull ratio, these folks are getting jacked all over the place, but they are tending to get a little bit more positive. Now, when this spikes up, that's when we're going down and they get into the bearish mutual funds. When this comes down, they're bullish and they're getting into the bullish mutual funds. The latest reading from the National Financial Conditions, we're still well under this black line, so there's no concerns there. And the latest reading from May 3rd with the real-time SOM Rule Recession Indicator, we're still below this red line. If we go above it, that's when we get concerned. This is also from a week ago, the smooth U.S. recession probabilities. We're above the black line, but we get nervous if we go above the red line. And the Brave Butters, this was updated at the end of April. This has been coming down for right now, not really causing a concern. As far as inflation, this adjusted during this past week as PPI and CPI were coming out. We still have PCE that's going to be due not this week, but the following week. So inflation will just adjust, but it's not really gyrating all that much right now. Here's the Fed, and I'm not only including the next meeting, I'm going with the next 2 meetings after this one. And there's a 91.1% chance that the Fed's going to leave rates unchanged at their meeting on June 12th. And that's pretty much locked in. You still have some folks that are still thinking that we're going to cut rates 25 basis points, but things are going to have to really turn weak for that to happen. Here's how things have changed. This is where we're at right now with the dark blue bar, day ago, week ago, month ago. And we're seeing a little bit more interest here in a possibility of a 25 basis point cut. Because the market, first it was March, then it was May, now it's June and July. And Now you'll see that I'm going to show September. That's what the market's more focused on right now. This is looking at the July 31st meeting, where there's a 70.4% chance that they'll leave rates unchanged, a 27.6% chance that they're going to cut them 25 basis points, and a 2% chance that they're going to cut them 0.5%. And then this shows how this has changed over the last period of time. And now we're starting to keep an eye on September 18th, where there's a 49% chance that there's going to be a 25 basis point cut. There's 35% chance that rates will stay the same. There's a 14.8% chance that we'll get a 50 basis point cut. And there's even a 1% chance of a 75 basis point cut. So this is where the market's kind of focusing on for right now. And this is going to change every day. And it's going to get more honed in as we get closer to that meeting. And here's how this has changed. We're still seeing a possibility of a 25 basis point cut. This is where we're at right now. That's getting the strongest probability. And then a day ago, a week ago, and a month ago, and how that has changed. This is the Fed balance sheet, which is continuing to go up for right now, even though we see it decreasing over here because the Fed is starting to, they're cutting down on the quantitative tapering. Doesn't necessarily mean quantitative easing, because that's kind of the opposite of quantitative tapering. It just means that they might come back in and start doing some buying. And that's what helped push us up after that decline that we saw in April. And this is looking at a year-over-year basis where we're still going down year-over-year overall, but it's not going down as much as it had been. Here's our chart. Looking at the advanced decline line based on price and volume, we're looking quite positive right now. We're well above the moving average. We're also seeing an expansion in new highs. We're going up with the 4-week average and the 10-week average as well. The advanced decline ratio is still looking positive. The accumulation distribution, we're positive on the daily chart. We're positive here on the weekly chart. Our trend, we are starting to go back up with the green line, but the ADX is still below its moving average. It's trying to turn back up. If we see some more follow through, we could turn back above the moving average and show a strengthening trend. But it's still positive for right now and getting a little bit stronger since the green line is going up. The Arun starting to get to an extreme positive reading. What this measures, the green line, these are buyers, and that's pegged all the way to the top. That means those are the ones in control. The red line are sellers, and that's flatlining at the bottom. And the down here is the oscillator, and that just measures the distance between the two. And when we see this kind of a reading, other times, this could be taken as extreme positive. It could also show good momentum. You can also see other times when we stayed up in this area for lengthy periods of time. The mass index, we're not seeing anything here on the weekly chart. It's the daily chart that's been triggering the signal that right now looks to possibly be a false signal. Here's our daily chart where we're looking okay. We do have some pivot points above current prices, but that's just the resistance that we're seeing on this chart. We're above the 50-day moving average and setting recent all-time highs. This is a daily chart, so you can see how for pretty much the whole week, we were below this moving average line as far as volume. We're positive across the board with the Keller market model with the S&P, mid caps, small caps, and NASDAQ 100. We're still looking negative with bonds based on price in the intermediate and long term. We're back to positive across the board with commodities, and we're seeing a short-term downtrend with the US dollar index. No changes here on the decision point scorecard. As I've been saying in the daily videos, I don't know if somebody actually has to come in and change this or if it's automatically changed, but it hasn't changed. It still shows that we're negative in the short term, according to the PMO, but we're positive. When you look at the chart, we're still positive with the short-term trend model. We're positive in the intermediate and long term. We're positive in the intermediate term with the PMO, but still negative in the long term. But don't take this as the final fact. Look at the charts themselves if you're using those to make decisions. Here's our trend channel. We're still above the midpoint and going up. This is still looking quite healthy. And I actually was able to stop showing this in the daily video now. We're a couple of 100 points above this48 level now. So this is looking more positive. Now, if we really keep rip-roaring up, we're about 48 points away from this R2 level. This could end up providing overhead resistance as well. On a trending basis, the 50-period moving average, that's the red line. It's going up as price has been going up, and price is above the red line. And you're going to see a lot of the same thing in these charts. This is a moving average crossover where the blue line's above the red line and price is above both of the moving averages. That's positive. We're coming down just a little bit with the McClellan oscillator after we had been extreme positive. And the summation index based on price is looking positive and also based on volume. So this is more longer term positive. The Swenlin trading oscillator, we're actually coming down a little bit based on price. We're still kind of flat right now based on volume. We're seeing a little bit of a negative divergence on the daily chart right now too. So we just want to keep an eye on this indicator. The bullish percent index, we're just under 70 and this has been climbing. That is positive. And looking at the PMO, this is our momentum oscillator. After just about crossing down below the moving average, now it's trying to turn back up. We're looking better when we break this out based on price as well as volume. And then we do some PMO studies. Came down just a little bit with the PMOs that are rising. The buy signals are still going up, and the PMOs that are above zero is also continuing to go up. So this is still looking positive. And we did close outside of the upper Bollinger Band after Wednesday, I believe it was, but we're not showing any kind of an extreme reading here on the weekly chart. And here are our different oscillators. We're coming down and trying to turn up with the short-term slope. We're still declining with the TSI. We're declining with the MACD, PMO, and PPO, but they are trying to turn up where we're still declining with the long-term TRIX and KST. Chicken money flow had been declining, but now we're starting to go back up. And if we see more follow through, the red line, which is a moving average, will turn and go back up as well. The chicken oscillator is above zero and going up. That's positive. The force index is also positive. We're still above 50 with the money flow indicator. And we had an up week, so we're above zero with the 1 week rate of change. And we go back 50 weeks, we are above this red line. So just to be aware of that, because we can go a lot higher than this red line that I have here. The RSI, after giving us an extreme positive reading, dropped down. Now it's starting to go back up and it's not extreme, at least yet. The weekly special K, just no matter what happens, this thing just will not turn positive. The daily chart is positive, but the weekly chart just will not turn back, at least yet. The Stochh RSI is crossing above this 0.5 midpoint. That's turning more positive. We're getting extreme positive with the Williams percent R. After coming down to 50, we're going back up with the ultimate oscillator. The vortex, after declining with the green line, it's now starting to go back up. That's turning a little more positive. The Copic curve is still negative, where we're positive on the daily chart, and we're above this 10-week moving average. We were able to come down, that support level held, and now we've been able to clear back above that. The 253 period simple moving average of the equity put call ratio is continuing to decline, and that is positive for the market longer term. We're also starting to roll over when we look at the VIX and then take a 3-month average of the VIX and then do a ratio. When this is going down, that is more positive for stocks. Looking at our trends, we're positive with the Heiken Ashley weekly chart. We're positive with the Kagi chart. We're positive with the Renko chart. We're positive with the 3-line break. And we're positive here with the ease of movement here, where we're above zero and starting to go back up on the 14-week version of this indicator. We did see a couple of new X's drawn in here, and we're seeing the same thing on the daily point and figure chart, a double top breakout, which to me sounds like some kind of a dance. But this is showing some improvement as well. Momentum studies. Long term, we're starting to flatten out and go back up. We're turning back up in the intermediate term, and we're positive with the long term. And then 50-day cycle, we're at some point, I'll start trying to figure out when that 50 days actually ends. And then I came across, because when we're really going up, for some reason, I can handle perma bears better. And I have a few that I follow and watch. And this one gentleman took like 35, 40 minutes to explain something that he could have explained in 8 or 10 seconds, but he wanted to draw it out and make it sound all dramatic and everything. He came up with this idea of a 197-day cycle. Well, that cycle just ended not this past Friday, but a week ago, and we're still going up. Now, this seemed to have some validity because it looked like we topped out here, we bottomed out here, we topped out here. It's not as effective here, but it did pick the top back in late 2021, early 2022. It picked the bottom in 2022. It picked the top in the summer of 2023. Didn't really pick this other low that we saw back in October. And so I was willing to look at this and say, okay, we'll just follow this. Right now, it's not really helping. The problem with these cycles is once you find one that works, then it has a tendency not to work. That's why I like cycles. I like to study them, but I don't put an awful lot of faith in them because somebody may come up with a 134.45 day cycle and find that that works. Okay. We are positive with the Elder's Impulse system on the weekly chart for the S&P. We're positive for the second week now with the parabolic SAR system. And we're in the month of May now, where we have been up over the last number of years from 2020 to the present time with a return of 2.1% for the month. And then looking at the S&P where we're setting all-time highs, the mid caps have not set an all-time high and the small caps still have a ways to go. So we're not seeing across the board confirmation here where the Dow, NASDAQ 100 and S&P have been setting all-time highs this past week. Looking at the Dow, we are in a solid uptrend and we're above 40,000 for the first time ever. The NASDAQ also setting new all-time highs this past week and in an uptrend. The NASDAQ 100 is in an uptrend, setting all-time highs. And this is another look at a candle chart showing the new all-time highs. The mid caps still have a ways to go, but they're holding up and looking better, stronger term. Okay, longer term, they're looking stronger. The small caps are still coming up into the high end of the range that we've been in pretty much for all of 2024. And then looking at the forward PE for small caps, and I showed this in the daily video, and you might go, oh, you can look at this and go, okay, we're at a PE of 15 right now looking forward. Ooh, that would be a good time to get into small caps. You can't always base things just on their price. I mean, you might see something on sale that usually costs $10 and you can get it for $5, but if it's a piece of garbage, you just wasted $5. Now, I'm not saying the small caps are garbage, but they haven't proven themselves yet either. They've been just treading water so far this year. But right now, when you look at them on a valuation basis and you're willing to wait and wait and wait and wait until they finally go up, yeah, you might consider buying them. But that's not the way I do things personally. The NYSE also setting new all-time highs and in an uptrend. The Wilshire, another broad market index, this is a daily chart, and it did set a new all-time high earlier in the week. All stocks are also looking really strong. The 30 biggest software companies not doing all that great. They're still in an uptrend. They came up off their 200-day moving average, but they're still battling with their 50-day moving average. Excuse me. They came up off their 50-week moving average, and they're still battling with their 13-week moving average. I get so used to looking at daily charts, I get those mixed up. The FANG index set all-time highs this past week. ARK not really participating either. It was up 5.89% on the week, but is really not breaking out the way it used to be in the good old days. And we have the bank index where it's looking a little extreme with the RSI. We've been going up on the price chart and the momentum continues to be positive. And deposits, we're starting to see money going back into banks, which is showing confidence in the bank sector, which can include some of the regional banks. And here's just a weekly chart of Dow theory where we're setting all-time highs with the Dow. The transports still have a ways to go. We still have a ways to go with utilities as well, but they've been really strong over the last few weeks. Some broad market looks here. The commodities on the weekly chart were still in an uptrend and coming back down to their 13-week moving average. Oil, after spiking up when things started to go crazy in Israel, now has been bouncing kind of under 80 and staying there. Copper has been showing a lot of strength. This shows economic strength going forward, and that is in a longer-term uptrend. The dollar has been pulling back, but is still in a longer-term uptrend. Gold also had a pretty good week. It was up 2.25% in a longer-term uptrend. Silver actually came out and broke above these previous highs. It's also in an uptrend on the weekly chart. And we're starting to see some improvement here with bonds based on price. We're still in an uptrend with the total bond ETF. The monthly chart of stocks to bonds, that ratio shows that stocks are still outperforming. We're still looking negative here when we take the 1 month and subtract the 3-month yield, and that's the way it should be. Here's a daily chart of yields where they had been coming down, and that's been giving support to stocks. The weekly chart also shows that US, UK, and German rates are coming down where Japanese rates are still going up, but they're low overall. Relative studies. Now we have gold, which is performing the best going back to the beginning of the year, followed by oil, then stocks, then the dollar, and bonds based on price are still negative. The ratio between the NASDAQ 100 and the S&P still looking okay, but when we see the NASDAQ 100 really outperforming, that's where a lot of the strength has been coming from. It might be getting ready to improve, but it's not falling apart, but it's not showing a lot of strength right now either. The S&P 100 is really outperforming the rest of the S&P 500, and that's the bigger stocks that make up the S&P. Growth of value, we want to see this doing better, even though it is positive. And gold to the S&P, we're finally starting to see a longer-term golden cross here, where gold is finally starting to outperform the S&P on a longer-term basis. And gold is still outperforming the US dollar. It broke out above this trend line, but bonds continue to underperform stocks on a longer-term chart. Low volatility stocks are still really underperforming. When we look at this ratio, discretionary, this is another area that we need to see doing better than it has been. It's actually breaking down, and we're getting ready to see a death cross here with the discretionary to staples ratio. Energy to tech. Energy was really bouncing back up. Now energy's been pulling back compared to tech. If this continues to go down, that would mean that tech is outperforming. And then our longer-term cyclical studies, we're looking good here with the NYSE breadth thrust. We did have a ZWAG NYSE breadth thrust, but we were 1 day late with that being triggered. And maybe it was close enough so that even though it didn't come within the window, it still is showing that we were extreme negative and then we went extreme positive, even though it was a day longer than it's supposed to be. This is still holding up quite well for the present time. The Zoharchak method is still on a full-on buy signal. This is very long-term and has been positive for quite some time. Here's a long-term chart going back to 1987 with the S&P. We're well above this trend line. This is that same chart just showing how far above we are from that trend line. This is the NYSE new highs minus the new lows. They're starting to turn back up. They're still above zero, so that's looking better. And the 50-period new highs, new lows for the S&P is also starting to turn back up after it had been declining. The NASDAQ 100 is back above this longer-term trend line going back to 2009. That's looking better. And then this is the other chart that I got from a perma bear months ago, and they were just so sure things will have fallen apart 8 times by now. Well, this hasn't fallen apart. We're waiting to see this ratio going down. It's actually right back to these high levels. And this measures the NASDAQ 100 compared to the Dow. We did get a very high reading when we saw the dot-com boom and then the dot-com bust back in the year 2000. And then it took a lot of years to get back up to this. Right at the end of 2021, we saw this high ratio again. Then we went into 2022. Now we're back up at this level. And we've been at this level going back into all of 2024 and even into 2023. We're waiting to see this come down, and it's just not doing that, at least yet. Another very similar measure looks at the QQQs, which is the NASDAQ 100, and compares them with the small caps. The perma bears think we should be headed lower right now. We're actually near this blue line, which is a very high reading. Here's a new one, semiconductors to the Dow. This did come up to the previous high reading that we saw before. It was starting to fall and the perma bears were starting to salivate, but now we're starting to go back up with this ratio. And then looking at the cumulative new highs, new lows for the NASDAQ, it's still coming down just a little bit, but if we see more follow through, this could start to turn back up, and that would be longer term positive. And we're keeping an eye on the 3-month yield. It's been flattening out right now. If this really starts to fall, that's when we get nervous. As long as it stays where it is right now, it's not causing any concern. Seasonality, this is put out by Don Bird. And for May, we do see some seasonal weakness. We're not really seeing that yet, but we're only halfway through May at the present time. And then we see a really nice up move going into the end of May, and then June, July, and August, we do see some positive seasonality. And this goes back to 1950. And there's no guarantee that this is going to happen again this time, but this is what has happened historically. And then looking at 1982 and then comparing it with 2023, we're still really outperforming what happened in 1982, and that led to a really nice long bull market. And then looking at May, going back to 1950, we have a good track record, but the average return is not very good during an election year. And then May, it's okay. we get about a 1% return going back to 1950 overall. And then we look at May here, where it's not as strong as April was, but it still ends up not being down when we look at it this way on a world seasonality basis. And then we do see some weakness into the latter part of May here on this chart. We're getting near the end of the first half of May, where sometimes we see some negative returns. It hasn't played out that way this year. And then during an election year, according to this chart, we're up 77.8% of the time with a 2.3% return based on the Carson chart. But when you compare May through October, this tends to be the worst performing 6 months of the year. And then looking at this though, but over the last 10 years, things have turned a lot more positive. We've been up 90% of the time with an average return of 0.7% with a median return of 1.1%. You can see back in 2019, we ended up having a down May. And then looking out a little further, where June, July, and August are positive on a seasonal basis. There's never any guarantee with this. We use this as a guide. And then looking at Stock Traders Almanac, where we do see some weakness going into the latter part of May. And we also see this on the Carson chart before we see some strength after that. And then comparing 2012 with what we've been doing, this was some weakness that we should have been seeing, but we're just not seeing to date anyway, before we see some more strength going into the rest of at least 2012 played out that way. And then looking a little farther out, June to August tends to be a pretty good upward time for the market. So thank you. I really hope you found this helpful. Please feel free to check out the other videos that I post. I hope you have a very good weekend, and I will talk to you in the next video.